Welcome back to another episode of the Market Outlook series with me, Kavita Agrawal, the founder of EXP Invest. EXP Invest is a swing trading advisory. So, if you're interested in short term or long term swing or momentum trading, then do visit the website. You can also join my Telegram channel, which is linked right below here. Now, we are here to discuss the chart of Nifty and assess what's going on so we can plan our trades in the coming weeks accordingly. So lately, Nifty has been experiencing a lot of volatility and bearish activity. Upside has been very limited, and even if there's been any upside, it's been overcrowded with a lot of whiplashes. So let's start off with the weekly time frame of Nifty, and then work our way to the lower time frames. We will also take a look at the other sectoral indices. So on the weekly time frame of Nifty, there is an upward trending channel. Now, this upward trending channel has been breached slightly here. Does this concern me? At this point, I would say it does not concern me because this is clearly a deep correction. And before breaking this channel on the downside, we can see that the channel was also breached on the upside. So, this you can say was a sort of a bull trap, or this was the euphoric rally where typically a lot of retail traders come into the market and think that the market is never going to go down. This is very, very typical of a market giving this kind of a rally before it actually goes into a deep correction. So this deep correction right now you can see is hovering very close to this blue line. Now what is this blue line? This blue line is the 250 EMA of the daily time frame. Now on the weekly chart, why am I looking at 250 EMA of the daily time frame and not the weekly time frame? Simply because number one, it is a widely followed EMA. Secondly, why 250 not 200? Because 200, as common as it is, does have a lot of noise. 250 reduces the noise that the 200 EMA may experience. That is the reason why I use the 250 EMA and not the 200 EMA. Here is the 250 EMA has been breached, but witnessing consolidation since the past 2 weeks near this level. If you see, the 250 EMA has acted as strong support time and again and has led to the end of corrections and beginning of new rallies in the market. Like for instance over here, for instance over here, for instance over here. COVID was anomaly again over here. This was also discussed in the last week's Market Outlook series. Right now, I think the key ranges that we want to see Nifty give a breakout above are 23,000 and 23,340. On the weekly time frames RSI itself, if you see, currently the bullish momentum seems quite intact. I am saying that on the basis of the fact that the RSI, when the high was forged, was still well above the level of 70. There's no negative divergence to be seen. And the RSI is still in the positive range, which means it has not broken below the level of 40. And on the rally, it was still above the level of 70. So the weekly time frame of Nifty is still very bullish. Time frame lower to the daily time frame. On the daily time frame, what we are witnessing is that in the previous leg of correction, that is the correction which ended on 21st of November. In that correction, we witnessed the Nifty RSI 25 period, mind you, not the 14 period. Again, the reason we use the RSI 25 period instead of the 14 period is to reduce noise on the momentum indicator. It helps us identify signals better and make patient decisions, which lead to better outcomes than the 14 period RSI do. And I switched from the 14 period RSI to the 25 period RSI after a lot of testing spread out over months and hundreds of stocks. Last time the correction came about, we saw that the RSI breached below the level of 40. This time, the price has already established a lower low compared to the previous low, but the RSI, if you notice, is sustaining or trying really hard to sustain above the level of 40. So what that means is that when this low was established, by the fact that the level of 40 was breached, that was a signal that more correction will come. So the rally that followed after the correction was short-lived and we saw a deeper correction this time. Now, since the RSI has established a higher low, we can say there is a positive divergence between the RSI and the Nifty prices. So the price needs to establish a higher high to confirm the positive divergence. And I believe that level above which it needs to establish itself and sustain itself is 23,340. Now, taking a closer look, you can see since 13th Jan, when we saw a massive gap down opening and lots of volatility, market has been sort of range bound throughout. It went up to retest the resistance three times, but each time it has fallen all the way back to the 23,000 level and it's testing that support. Now, I personally believe that we are definitely very close to kind of creating a bottom here. And if we do see more correction here, I wouldn't expect the market to go below 22,700 in this leg of correction. Subtle signals of positive reversal have already started to emerge on the chart. But then again, nothing can be said with certainty until there's more clarity on the daily time frame. Moving down to the 75-minute charts. RSI has been in a very clear-cut bear range. What do I mean by that? If you see since 3rd October 24, when the RSI breached below the level of 40, and subsequently the level of 30. Since then, we've stayed sub levels like 70s, and on the downside, we've been breaching the level of 30, except for when? Except for on the low that we saw on the 13th of January. Now, the RSI has created a double positive divergence here, one between the lows of December 20 and the low of 13 Jan. Another positive divergence is between 13 Jan and 22nd Jan. But again, this also needs to be confirmed by the price establishing itself above the resistance of 23,340. So there are positive signals building up, but that does not mean that we get reckless in the market. So as a swing trader or momentum trader, the strategy when the market starts creating a sort of consolidation zone after a strong correction is that you definitely commit capital to the market. You don't want to miss the initial leg of the upside, because when that happens, that unfolds really fast. And that is where you actually end up recovering a lot of the losses that you might have made by stop loss triggers during the correction. So you do commit capital to the market, but you also observe strict risk management. Sure, it will lead to some whiplashes. It's part of the game. You cannot sit out of the market or not use stop losses because of that temporary and necessary pain in the market. Time frame is also giving us positive signals awaiting confirmation. So this is about Nifty analysis. We will now move down one time frame lower to the Bank Nifty analysis. What I observed the last week, we saw a breach in the level of 40, and a key support for Bank Nifty lies around the level here, 47,300 or maybe 400. That I think is where the support is to be expected. But looking at the weekly time frame, I think the level of 40 is being tested here. So for Bank Nifty to actually commit a lot of capital to the private banking sector, I would want it to sustain above the level of 50,000, which on the weekly time frame you can see is a key resistance zone. Coming down to the 75-minute time frame, I think even the 75-minute time frame is looking a lot weaker for Bank Nifty than it is for Nifty right now. So I think it looks very likely that the support 47,300, 400 range might get tested in Bank Nifty. So I think auto sector is starting to look very attractive. Even specific stocks in the auto sector have been giving positive signals. The 75-minute time frame here is showing a positive divergence, but again, it needs to establish a higher high above the level of 22,600 for me to start acquiring positions. I don't think the commodity sector currently looks very, very attractive. It is well 250 level, 250 EMA level, and the weekly time frame is also not looking very particularly bullish. So I'm going to avoid the commodity sector for the time being. What about the consumption sector? So the consumption sector is showing a positive divergence on the daily time frame. It is also very close to the 250 EMA and is testing out that level. It has a strong resistance close to around 11,700, which I would like to see it overcome. Even if it can sustain above 11,100, I think even then the consumption sector would look attractive. Now, one stock in this sector that I think is looking attractive is Tata Consumers. Uh, stock that is on my radar currently. The 75-minute time frame is giving sort of mixed signals here. So I will go ahead and set up an alert at this point and call it higher high. So when the sector goes above that, I'll automatically get an alert from the charts. Energy sector. So like I said, the energy sector continues to look quite weak. Again, on the energy sector, before I start taking any positions, I would like to see the establishment of a higher high, at least on the 75-minute time frame. Ideally on the daily time frame, but the 75-minute time frame is the least that I would like to see. The finance sector. Okay, so the finance sector has been showing a lot of volatility, but between these two lows, I would say there is a sort of positive divergence that has been formed, which again needs to be confirmed. So just like Nifty, the other sectoral indices are also showing signals of potential bottom out or consolidation, but we are awaiting confirmations. Currently, around, I would say 60 to 70% of my capital has been committed to stocks where I see strong potential. And stay tuned because at the end, I want to make an announcement about stock analysis, which a lot of you might find useful. But coming back to this, so about 60 to 70% of my capital is invested. I'm keeping the rest in cash to wait for the market to kind of turn around and give better quality signals or stronger signals with better risk reward ratio, and then I'm going to invest or trade in that. FMCG sector. FMCG has established a new price low, but if you look at the daily time frame, a strong positive divergence has been noted. Also, speaking of individual stocks, stocks like Dabur, Nestle India, Hindustan Unilever are giving strong positive signals as well. So there is volatility in the market, and the FMCG becomes positive for some time, looks strong, but then goes back into correction. I had noted that it looked bullish. It did give a rally, but then again, it experienced resistance and stopped rallying after that. It came back to retest the previous low. And in doing so, it has again created a positive divergence. So you can see in the previous rally, the price, even though it did not breach the previous price high, the RSI has gone above the level of 70, which is something that we did not notice in the RSI last time. So this indicates to us that there's been a subtle momentum shift and things are looking more bullish for the FMCG sector than they were earlier. So when it comes to RSI study or momentum study, looking at these very subtle shifts and looking at the RSI's plotting corresponding to price action is very important. Infra sector continues to look bearish to me. The 250 EMA has been breached after a lot of effort, and now it's acting as strong resistance. The RSI is also well in the negative range on the daily time frame, negative range shift. And this was signaled a long time back with a big negative divergence on the infra sector index, and the subsequent and very slow shift into the negative range. Now, mind you, the underlying trend in the infra sector continues to be very, very bullish, but that's from a super long term perspective. Short term, infra sector continues to look bearish. I think the IT sector is experiencing intermediate correction. I would want to see this sector retest the 250 EMA levels and then start to reinvest. Also, if you look at the earnings of the major IT companies, Infosys, HCL Tech, they've created major negative divergences on the charts also. Of course, there are smaller IT companies which don't exactly track the path of the larger companies. So there are some opportunities there. One stock that I am keeping on my radar is Emphasis. From a broad perspective, the IT sector does not look very attractive right now. I think the metal sector, what it has done here, if you see, this has tested the level of 30 on the RSI, which is a big deal. And we can potentially expect a reversal and rally. The reason why I would say that is history. If you look at the 20th June 22 bottom, over there also the RSI exactly touched the level of 30 and then a massive rally ensued. This again was repeated on 28th February 2023. And again, we can see that the low has been tested. So if you want more confirmation, you can wait for a higher high establishment But I think the metal sector might have something to offer here. So keep metal stocks on your radar. The pharma sector has breached this important trend line very briefly, but as you can also see, it's been in consolidation, it's not gone into correction. Now, the 75-minute time frame is showing that while this consolidation has unfolded, the momentum is signaling a pickup. So, positive momentum seems to be returning. So, pharma stocks is something that I'm definitely keeping on my radar. There's been a lot of whiplashes because of this volatile movement. Stocks like Oro Pharma, Ajanta Pharma, Torrent Pharma. These are on my radar. Glen Pharma. These are on my radar, and I think there is opportunity there. So I, despite of the whiplash and the pain of repeated stop loss triggers, if I see a trade setup with a risk reward ratio of more than 3 appear on the charts, I am taking a bet there. I'm afraid the PSE sector, being cyclical as it is, continues to display correctionary behavior, bearish behavior. So I would expect the downside here to continue for some more time. PSU banking again. So I have had some really good trades in the past couple of weeks in the PSU banking sector, especially in stocks like RBL and AU Bank. And I think there might be some opportunities in trading here. And also for long-term investment, I think PSU banks look pretty attractive from long-term perspective currently. About that, on the index level, things are looking a little uncertain here, but on a stock-specific level, I think the smaller public sector banks look quite attractive. Now, the service sector has come down to the 250 EMA and is taking support. So the level of 30,800 seems to be a pretty good resistance. I'm going to create an alert there and also take a look at the service sector stocks to see if there's any opportunity surfacing there. Index is very similar to the pharmaceutical index, and we can see there's been a lot of consolidation, volatile movement here, but there's also positive divergence building up, which means that there might be an opportunity to explore in the healthcare sector. Take a look at the Apollo Hospital. I think there might be something brewing. That was the last index for us. So, with that, we come to the end of today's session. Now, for the announcement, I will be starting a series of analyzing stocks. So, in that series, I will be covering my 5-step process of identify, monitor, enter, trail, and exit. And I will be walking you through stocks that show opportunities. And as the series unfolds, we will be tracking the stocks which we have assessed earlier, how they move. The series will be unfolding against a Google Sheet, which will track all the data that we are covering, trailing stop losses, targets, entries, exits, re entries, all of those things will be tracked there. So, if you are interested in knowing more about the series, or if you're interested in staying up with the series, getting a link to the Google Sheet, following me through this journey or staying with me through this journey, why it's going to be significant for you is because it'll offer you very important opportunity of learning how technical analysis is done. Now, in each series, I will cover as much as I can, but what you will see most importantly is that things are going to be repetitive. To succeed in the stock market, you have to be comfortable with monotony. You cannot be chasing new strategies, new approaches, new indicators, or new principles every day in the market. You need to strip down what you know to the bare basics, and that is really, really, that's a lot harder than you would think, right? So I have been doing that with the help of trade journaling since the past 13 years that I've been active in the market. And through this series of 100 days of stock analysis, I also want to take you through the journey so that you get a first or a second hand experience of how it is done professionally, right? So if you want to know more about the series and if you want to get posted, stay updated with how the Google Sheet is getting developed or how the movements are being tracked, then make sure that you join my Telegram channel, Trade with Kavita. When you do join my Telegram channel, just be aware that there are some fake channels running with similar names. So, what I will ask you to do is take a look at the posts. If you see anything related to options or crypto, that's not me. But if you see quality posts, if you see quizzes, if you see this book a call with me, if you see my analyst comments with charts and details of my videos with thumbnails, links to my YouTube, that's my channel. So, with that, we come to the end of the session. Thank you so much for giving me your time and your attention. If you have any questions for me, feel free to drop them in the comments below. I'll be more than happy to help you out. Thank you so much for watching. Namaste.